I'm your host, Alton Hill, and we are uncovering ways to increase your worth, not only monetarily, but most importantly, through fulfillment. This podcast is about learning from those who've been successful and modeling their characteristics. Come along as we learn together and explore different strategies, not only to grow your wealth, but also how we can stay fulfilled while we're doing it. If you're new to the podcast, welcome. We have several other episodes available on iTunes or any of the other podcast apps. You can also log on to futuremoneytrends.com and get this here or on the Future Money Trends YouTube channel. So while this podcast is a great way to pick up good tips for wealth building, if you're not already subscribed, please go to futuremoneytrends.com, put in your email, get subscribed to our weekly newsletter. There's awesome stuff in there and it's free, so no reason not to subscribe. You can also check out our weekly wealth digest videos, which is a good way, especially if you don't like to read and you just want to turn those on the videos. It's a kind of a video format of the newsletters. So thanks for listening. And if you have any questions about anything, please reach out to me at alton@futuremoneytrends.com, ALTON@futuremoneytrends.com. Everyone that's familiar with Future Money Trends is familiar with how we like to look at strategies for the new economy. Many out there have a lot of faith in the record high stock markets. And while I'm sure that many have profited from this, today we're going to speak with Steve St. Angelo from SRSRockerReport.com. For those of you who are not familiar with his work, he does a lot of unique energy research and analyzations that no one else is doing. He's had articles published on several different sites, from peakprosperity.com to Zero Hedge. Steve has been kind enough to join us today to tell us a little bit about what he sees on the horizon and some measures we can take to prepare us for what may come. Steve, it's great to have you on the show today. Welcome.
Thanks, Alton. Yeah, I think we have a lot to discuss, and I'm looking forward to talking with you.
Yeah, so before we get into talking about wealth preservation, Steve, I know that you do a lot of in-depth research. You really get into the details, but we have an audience that has heard a lot of your interviews, but we also have some that aren't as familiar. For those that may be listening who are not as familiar, do you think that you could give us maybe like a 30,000-foot view, kind of a summary of your feelings on our economy and some of the potential looming risks?
Sure, and I know this is a more geared towards wealth creation, and my view from looking down on the earth is that we're going to transition to more wealth preservation, because from my analysis is the energy has allowed us to actually grow wealth and accumulate wealth. It's been due to the energy, whether it's natural gas, oil, coal, whatever. Mostly oil. Oil runs the economy. That's without boats and ships and cars and trains moving, we don't have an economy. And so what's interesting, and this is what's fascinating, and I mentioned this in a previous interview, but the U.S. consumes about 20 million barrels of oil a day, 20 million. What that equates to, Alton, is 54 billion people working 8 hours a day. That's how much. So I look at things, even though Trump's in the White House now, I'm glad he's in the White House. We're not going to have a war with Russia. That's what it seems to be. There's other problems. But this whole hype with the stock market going up and continuing to go up and that Trump will make America great again, I don't think that's not going to happen. And that's due to the energy. So I wanted to start this interview on that note.
Yeah, I mean, I think that definitely the stock market's surging, but tell us a little bit about why you think that maybe that's inflated or that's not reality.
Okay, recently I came across a couple of very, very smart individuals, and they're looking at the energy situation, oil production, and there's peak oil, and then there's the energy return on investment. Some people don't believe in peak oil. I believe in it. And then if you don't believe in it, well, you can look at the energy return on investment. And the energy return on investment is just how much energy you get by how much energy you invest. And back in the 1930s, we'd invest 1 barrel of energy, the actual energy, and we'd get 100 barrels from the market. Now shale is putting out about 5.
Wow.
So the thing is, those are factual numbers. We're just not getting the profitable energy we used to get years ago. And then the thermodynamics, because a lot of oil companies, a lot of national oil companies like Saudi Arabia and in Russia, a lot of this information is hidden. So the thermodynamics gives us an idea of what we're going to see in the future. And these gentlemen, the Hills Group and Louis Arnault, suggest that the net energy that's left over in a barrel of oil, since we started producing it, there was a lot left over that went to the market. They're saying within the next 5 to 10 years, that is going to totally dissipate. And that actually produces the GDP. So this is the problem we're facing. Now, what happened was, and that's the reason why I told you that information, the Hills Group actually have this ETP oil model, and they had 2012 as their inflection point. That's when the maximum consumer price of oil, and they calculated the price of oil based upon the cost of oil, and it hit in 2012, and they see it continuing to fall. And supply and demand won't matter. It'll add volatility throughout the years, but the trend is going to be lower. So what happened in 2012? Well, in 2013, we came up with QE3. And what also happened, the precious metals and energy started, well, precious metals first went into the toilet. So if you look at a chart of, let's say, the S&P or the Dow Jones, and then you take a look at gold and silver and oil, especially gold and silver first. Oil came about a year or two later. But everything, the commodities and oil started to fall, really fall. And so we've had this dislocation. Well, the only way you can build the Dow Jones average, the only way you can build the amount of the GDP or the Dow Jones Industrial Average stock prices, you have to have increasing oil production as well as increasing oil price. Well, that stopped in 2012 and 2013. So unfortunately, the Dow Jones is being propped up by debt. And I mentioned this in other interviews. The U.S. debt has increased 23 times since 1981. It's now almost 20 trillion. And the Dow Jones Industrial Average has increased 23 times since 1981. So this is the issue. The Dow Jones Industrial Average is a Ponzi scheme, and it's based upon the increase of debt. And I'll conclude by saying the debt can increase when you're continuing to have new oil production, affordable oil production. When that starts going south, then it's going to pull the rug from underneath stocks, bonds, and real estate.
So you talk about affordable oil production. I know you've given some statistics in the past about the debt that the oil industry is in. Do you have any of those that are up to date?
Well, let's forget the top 3 oil companies in the U.S., which is ExxonMobil, Chevron, and ConocoPhillips. Let's look at the shale producers. According to a chart I'm looking at, it includes Anadarko, Apache, Chesapeake, Devon, EOG, Hess. I can go down, Pioneer, Range Resources. If you add all their free cash flow since 2009, it's been negative. Now, some companies had positives, but when you add them up as an industry, they were negative $6 billion in 2009. 2014, the total was $24 billion. And in 2015, it was $23 billion. In 2016, it's going to be even higher. We don't have the estimate yet. So since 2009, our shale industry that we're supposing that's going to save us hasn't made any money. Now, the top 3, which is ExxonMobil, Chevron, and ConocoPhillips, they're in serious trouble. And I have a chart that I just made today. They made $80.4 billion in net income, these 3 in 2011, $80 billion. This year, the results just came out. They're going to make $3.7 billion.
Wow.
That's it. Now, that just tells you what their net income is. That doesn't include the capital expenditures and their dividends. If we include all that, ConocoPhillips, Chevron, and ExxonMobil paid $29 billion more for capex and dividends than they made in operating cash. So their debt is exploding. And I'll just tell you one last digit here, one last figure. Last year, their debt was $82 billion. It's now $101 billion. It's almost increased $20 billion in 1 year. It's actually almost doubled since 2013. We're heading in the wrong direction. And unfortunately, when people think the price of oil, once it recovers, then these oil companies will look better. No, the thermodynamics says that the price of oil will continue to trend down because the value of the oil isn't worth it. And so it's really going to gut the U.S. energy and global oil markets. That's why the world investors have to start switching over from wealth accumulation to wealth preservation. I'm not saying it's going to happen this year or next year, but the trend will start. It's like moving a switch across. It'll start getting worse and worse every year. So you want to start trending to more wealth preservation in the next several years.
So could I summarize some of what you said? I'm sitting here thinking about what are some of the indicators to verify or to validate what you're saying. Are you predicting that the gas prices that we pay or the price per barrel will continue to go down and that would be confirmation of what you're saying?
Yes, and we have to look at it this way. It goes against the whole idea of supply and demand. And I believe in supply and demand. It does impact prices. It does impact prices more in different aspects, but when it comes to energy, commodities, and metals, it's more on the cost of production. When you look at it over a long period of time, and the Hills Group did this. They looked at oil from the 60s, and they actually made this model, and they had this line, and they actually forecasted what the cost to produce oil. Well, then they took the average price of oil, and they superimposed it each year. Well, it almost matched perfectly. And so they're forecasting now the price will continue to fall because the net energy in a barrel of oil that makes it to the market continues to decrease. So there's less GDP that will actually able to be produced. And so I've said this before. You have to look at it like a brand new car, which is you spend $25,000 or $30,000. All the parts are brand new, the engine, the radiator, the electronics, whatever. Everything is brand new. You can have 10, 15 years. You could use that car. You take care of it. Well, let's say you want to sell that 15-year-old car. There's not much value left because the parts are all worn out. And so it's worth like 5 or 7. This is what's going to happen with oil.
Right.
And it's going to continue. And so now it's different if the value of the dollar collapses. That's different because we have no idea of what the real value to price things, commodities, especially precious metals and energy, because the U.S. dollar, the debt, and the fiat monetary system have kind of manipulated the real value. But unless the dollar collapses, we will continue to see a falling oil price. Now, it could shoot up. We could see volatility, but the trend over the next 10 years will be down, and so will the price at the pump.
So, what would you tell someone who's listening that may be more optimistic than you are about, hey, President Trump's in there, he's going to make America great again? I mean, what would you tell people like that?
Well, it's hard because to get to the root of the problem, you have to really understand the situation. Like there's this idea that the Russians are producing this abiotic oil that's very deep. I did the research. The Russian companies, Gazprom and the others, they're actually now drilling horizontal wells just like the U.S. They're doing shale, and so they're drilling a lot more wells and a lot more footage or meters per well, and so that's very expensive. Well, this is not something that's going to last, and so when we see these issues that's happening to the major oil companies who are supposed to be profitable, they're supposed to be profitable, and now they're not making money. And let me tell you, right now the price of oil is about 45. It's been like between 45 and 50 this last year. If you go back when the price of oil was 45, 50 in 2004 or 5, they were making money. But now they can't make money now. So they're not making any money, and to bring on new production, Alton, they need $120 price of oil. To bring on new discoveries. They really need a price of 110 to 120, and we're not even anywhere near there. And we're not going to go there because the value of the oil isn't worth it. So, unfortunately, very people who are optimistic that Trump is going to do something, I imagine he's a lot better than what we could have had in there under Hillary Clinton presidential candidacy. But I think the issue is the debt that is overhanging the whole system is becoming unmanageable, and it was somewhat manageable with a growing energy supply, but I think we're hitting that top now, and so now the debt will become very problematic, and there's really not a lot Trump can do with that. So I'm not saying it'll happen in his first year, but as time goes on, we're going to see much more difficult things happening with the energy and the economy.
Yeah, so I want to switch gears a little bit and see if you could give us some insight on how you got into doing some of this research. Clearly, you're very knowledgeable on all of this, and you've dug into a lot of things. So, what kind of lured you toward these types of things?
Well, years ago, I actually came across a gentleman, and I didn't know at the time, but he was the top engineer on the Apollo program. And I spent the summer working with him on a wetland wastewater treatment system for Cape Canaveral, Florida. And he taught me things I never knew. I never found out in school or in college. And the two things he told me was to learn to do as much as yourself, and to find the problem, you have to get to the root of the problem. And the root of the problem, you really got to dig deep. And most analysts don't do that, Alton. They tend to look more on the outside, and they'll use other analyst information. And so, to get to the root of the problem, you have to look at energy. And it used to be human and animal labor back in the day, back in the ancient times, actually up until maybe the early 1800s. Most of the work that was done was human and animal labor. And then coal and oil came on the picture, and it changed things considerably. And so we were able to accumulate all this wealth. And now there's really not a lot of wealth out there. And here's the issue that people have to understand. A home, let's say not a home you live in, but let's say a rental property. A rental property needs to have a constant flow of traffic to make that rental property or that home or the commercial building or the warehouse to give it value. If you don't have traffic flowing and business moving, that building isn't worth anything. And so the energy situation is really going to impact real estate. A lot of people, I think right now, according to this one estimate, 217 trillion is in the world's real estate. That's what the value of the world's real estate is. So there's a lot of wealth tied up in real estate, stocks, and bonds. Now, I'm not saying they're going to implode tomorrow, but if we keep an eye on the energy and watch how the energy starts to really hit a brick wall in the next several years, it will impact the value of these stocks, bonds, and real estate, and that's where most people have their wealth. So when you figure that there's 220 trillion of debt in the world, and there's about the same amount of assets, give or take, well, the assets are being backed up by the debt. And there's only about $3.1 trillion worth of gold and silver in the world. And that's physical, that you can get your hands on. So I see in the future, logically speaking, I see a transition out of those assets when people start to wake up. And it'll happen in time, and more people will wake up, and they will have to move into more physical gold and silver. And that's how I kind of see this transition happening.
So is that what you're doing to hedge against this, is to just own precious metals, physical precious metals?
Well, according to, many people, this is not a good trade. It's not a good, the precious metals, especially if you bought at the tops, let's say 11 and 12, you're considerably lower. And that is true. But I've been purchasing silver since 2002. But you see, the issue is we've been using the only reason why the shale oil industry in the United States really worked was because of zero interest rates and money printing. If we didn't have that in 2008, after the first financial crash in 2008 and 9, if we didn't have that, shale really isn't profitable. It really isn't profitable. It just takes too much energy to produce it. And even though you get five profitable barrels that come out of the well, that's only part of the issue. Our modern society needs 20 to 30 barrels per barrel that you put in. And that runs everything: the interstate highway, the rivers, the infrastructure, the technology, the entertainment, the healthcare, the education system. We need all that. All those profitable barrels have to run that system. And when you don't have them, it's not really worth producing that energy. And so what we've been doing is we've been using a lot of other methods to keep it going, which is debt, using a lot of debt. And so I do believe, even though I'm a little early, the precious metals, physical precious metals, are probably the best, let's say, store of wealth going forward. Now, there's also some options of different types of things. I'm not saying everything is going to implode. Certain businesses may do well. Certain mining companies, silver mining companies, may do well. But if you have to be simple and throw a dart at the wall, to me, the keep it simple, stupid, would be precious metals, physical precious metals. Yes.
So is that something that you're actively doing then?
Yes. I say, I do what I say, and I believe in them because of. And here's the reason why the precious metals are a store better than a stock, bond, or real estate. When that gold coin or silver coin was produced, it took human labor, it took energy, it took a lot of capital, and it's stored in that gold coin. Now, when you have that in your pocket, someone else has to do work. They have to give or exchange you some good that equals the value of that coin. And so it stays locked in there. Whether that coin was produced during the Roman times or whether it was produced by Barrick Mining this year, that gold coin has a store of this economic energy, as well as a silver coin. Basically, there's no energy debt. There's no debt tied to it. It's a plus. Someone else has to either do a labor or provide a good to take your coin. So you're ahead. Now, a stock, bond, and real estate, it's based upon future earnings. Real estate is based upon future people paying you the mortgage because the economic activity continues to grow or at least, sustain itself. And so this is the issue. Most of the stocks, bonds, and real estates are their energy IOUs. We have to continue burning energy in the future to keep those assets in value. Where gold and silver, no, they have already been spent, and it's a bank already in that coin. And that's the kind of basic assumption of why the metals are not only money, as they behave as money. It's because they're a store of this human energy and capital economic activity.
Well, I think that's great stuff and a really awesome perspective. Steve, thanks so much. Is there anything else that you'd like to leave our audience with?
No, if anybody's interested in understanding if this makes any sense to you, if you want to understand more about how things are going to unfold, and getting some data points or some key factors to look for, I put out 2 to 3 articles at the SRSRockerReport.com on what's happening with energy, what's happening with the economy, precious metals, and mining. I look at all of it because it all interrelates. Nothing is separate. Everything interrelates. So I just wanted to conclude, if anybody wants to learn more about this, they're more than welcome to come and check out the site.
All right. Well, thank you so much, Steve. And I encourage everyone to go check out the SRSRockerReport.com. Steve, it's been an honor. It's been a pleasure. Thank you so much.
It's been great, Alton. Thank you for your time.
All right. What a wealth of information from Steve St. Angelo. I want to point out a couple of things that he mentioned. The first being that the Dow Jones average is essentially propped up by $20 trillion in debt. And that's a pretty big deal. The other thing that I think he mentioned was how he compared that to a Ponzi scheme. And so I don't know. I mean, I don't want my money in the stock market if it's a Ponzi scheme. So definitely some things to consider. The other thing that he brought up that maybe not everyone's talking about right this second is we still have a $20 trillion umbrella of debt over our heads. And if you're trying to build wealth and gain wealth, that's something that you have to consider. You have to put that into your plans. The other thing that Steve did a great job of explaining was how our economy really revolves around oil and energy. And he also made the point, even your real estate, if you're going to have a home or a duplex rental, that it's just a potential there. And without the energy, it's not going to be that valuable. And I hadn't really considered that type of perspective on a real estate asset. The final thing I want to bring up is how precious metals are a real store of wealth and how they're not a store of debt. And while, of course, they could be used for money, having that concept that something that you hold is valuable is directly connected to the fact that it's a store of energy that's already been put into it before. Now, I know many of you hold precious metals, have physical, silver and gold already, but for those of you who don't, you can't listen to someone like Steve talk and really not have any precious metals in your house. That's just, I have some friends that the only precious metal that they have are silver dollars that I've given them for Christmas. And I don't see how you can try to grow your wealth and try to preserve your wealth without having precious metals in your portfolio. So I hope that you'll think about how these things can add value to your own life. I hope that you're motivated by these things to really think about pursuing your own greatness and to go take action right now. If this has brought value to your day or inspired you to focus more on what it is that you're passionate about, please subscribe. Or if there's someone you know that they may be struggling to live that fulfilled life, please share this with them. As always, thank you so much for listening. And if you have any questions for any of the guests that we have on, or something pops into your mind when we're going through the interview, feel free to send those to me at alton@futuremoneytrends.com. And when we do the mailbox mashup with Daniel, we could answer it, or, maybe we'll have the guests back on and we can dig deeper into some of those details. Thanks a lot.